3 stocks at a 52-week low: Budweiser, Match.com, and SWK, which is Black and Decker. I love stocks that hit 52-week lows. It's a great starting point to look for value plays. Why is that? Well, if they're at a 52-week low, there might be some emotional reason for it. Remember, I'm looking for disconnects in value. So I'm going to use our 8-pillar process and our software to look at all 3 of these companies. And then I'm going to use a stock analyzer tool to determine what price I want to pay for this company based on the assumptions I have for the future. So if you have our software, pull it up, check it out. Let's go do this. So Budweiser to start. I think we all know Budweiser quite well. $50, right around there. The 52-week high is 68. So not a ton different. What is that? 30%, not even 25, 28%. Let's see the 5-year chart. Ooh, quite a bit lower on the 5-year chart. 130, 125 on the high. So let's go look at the 8 pillars tab initially off the bat. All right. So here are the things that jump out at me. We've got a disconnect between free cash flow multiple and earnings multiple. I like the fact that the free cash flow multiple is lower. That means they're reporting more free cash flow than earnings. There's always a red flag for me when I see higher earnings than free cash flow. It doesn't mean it's a bad thing. I just have to understand it more. And I still want to understand this more. Now, they have $1.7 billion in revenue growth over the last 5 years, but $4 billion less of income and $1 billion less of cash flow. So the first thing I'm going to do is go to the income statement. So as you can see, 5 years, larger revenue. Now, why is the profit $4 billion lower? It was very consistent here. Well, not really, actually. 8 billion, 7.5. Big drops right here. So this tells me there might have been a one-time write-off. And look at this. $2 billion write-off here, $6 billion write-off here. $2 billion gain. So that tells me right there were one-time expenses they had. Your next order of business, if you want to do more research in this, is go figure out what those were. Go to the internet, go to their 10K, which is on our software. If you go to the metrics page on our software, at the very bottom, it'll pull up the SEC website directly, and you can look up that year's 10K and figure out why they had that one-time write-off. Remember, write-offs aren't necessarily a good thing or a bad thing. It's a bad thing in the sense that they've written something off that they said, hey, we got wrong on this one. Either we sold it off or we're taking an impairment charge on it. Now, if it's a consistent thing over and over, it's no longer an other income or expense. It's an ongoing, we make bad decisions, and you should factor it into your analysis. Okay, let's go back to the 8 pillars tab for Bud. All right. So they have a lot of debt here too. So let's look at their free cash flow. Their free cash flow in the last 5 years was 9.1 billion, and last year was 9.2. So it's very consistent free cash flow. They pay out a dividend of 2.3%, a nice healthy dividend, almost double the market. And that pays out $2.4 billion per year. Based on their free cash flow of 9 billion, they can easily afford this. So that's great. I always worry that people fall in love with a dividend without understanding if it's safe or not. So this is great to see. Now, look at this though. They have 11 times their free cash flow in debt. We're trying to find 5 times. Now, this is a very stable business. You know, these are kind of the vices that people love, and they look at it as a way of trying to enjoy their life. Let's go back to their income statement. Let's go back to so if you can see right here. So unfortunately, we don't have, I remember they had a different company back then because I wanted to look at the previous recession. See how they did during the last recession, but people tend to want to drink alcohol and it's a cheap way of having fun. So I think this is going to be a lot more secure during a recession. And therefore, maybe this debt level might be okay for the company. This might be fine for the company because they're such a stable company. Now, one thing I would understand and do more research on is go figure out how much they're paying on this debt, because debt levels, interest rates have been very low lately. And if they have a lot of this debt coming due soon, they're going to pay a lot more money, which is going to drive down their cash flow. All the more reason to be conservative. So now let's go to the stock analyzer tool. Now remember everyone, if you're new to this channel, I'm Paul. I'm a value investor. My goal is to look at the quantitative parts of the company, the numbers, and determine from there if I want to do more research on the qualitative parts. I'm trying to buy $1 for 70 cents or some sort of discount on good companies at great prices. The more you learn, the less you'll fear. I'm a big believer in that. The more you understand about a company, the less you'll fear it as time goes on. So if you want to understand more about me and my personal life, check out my Instagram account right there. And you can see all the stuff about my personal life, my dogs, my family, etc. So let's go look at the stock analyzer tool. It's really important on this tool, on this company and the next two, that you rewind this part to understand better about how I look at the future, because every investment is the present value of all future cash flow. but we don't know the future. So our job is to make assumptions about the future and then a wide range of assumptions and hope that the stock we can buy for less than those assumptions tell us. So let's start here. First things first, I picked 10 years of analysis. On our software, you can do between 1 and 20. I always pick 10. I don't think it really matters. I like a 5 or 10 year outlook, so I start with 10. Now, revenue growth. So guys, a big key here is how much organic growth do they have, okay? Because if you look at their cash flow statement, it will tell you how much they do in acquisitions. They have a lot of acquisitions here. Actually, they sold off a piece right here. Oh, actually, they sold here and they sold here. So I'm pretty impressed with this. Not as many negatives, which would be cash outlay for businesses. So I like this. They have some natural growth going on. So let's go back here, stock analyzer. So I'm gonna be conservative. I'm gonna go, there's inflation going. So I'm gonna go 2, 4, and 6%. Profit margin. Now guys, if you look right here on the profit margin section, last year was showing 6.9%. You can tell from the last 5 and 10 years, that's a lot lower. So I'm just not even look at that at all. So I'm gonna look at these two numbers. I'm gonna start with 9 to be conservative, 11 and 13. Free cash flow margin, a lot more consistent as you can tell, because they had those write-offs. So a lot more consistent the free cash flow margin. I'm actually gonna do 15, 16 and a half, and 18. Now for PE and price of free cash flow, their PE is higher because they showed less earnings because of those write-offs, okay? So this is not a justification for a high PE, but it's a great brand with a lot of stability. I'm gonna go 13, 15, and 17. And finally, for my desired annual return, because of the debt levels, you can get 9 or 10% for the market, but because of the debt levels in this company, sometimes I'll pick 12.5%, but here I might pick 15. Now you can change this to whatever you want. So once I'm done with them, I'm gonna hit the analyze button. It's gonna pop up 6 numbers, a low, middle, and high based on earnings and based on free cash flow. If it's all green, pump the brakes. It doesn't mean go buy. It means go answer those questions I had before and see if these numbers really make sense. Go look at their history. How stable is the business? My guess is Budweiser is a very stable business, but see how they're organically growing and how they're going to be as a company. How is the management team? What are they doing with the cash flow? Are they buying back shares or not? So we hit the analyze button. Scroll down below. All right. So the company is currently at $49 and we have half above 49 and half below. So from my guess right here, I look at this saying, you know what? I think I'm going to add this to my watch list at $42.50. So it's going to notify me on my software, on an email, and on my app, because this software comes in your phone as well. And if you're interested in the software, check out everythingmoney.com. It's a great way to really understand your investments and really increase your returns potentially in the future. So based on this, if I can buy this company for $45 or less or $42.50 or less, I will probably be able to do well. Obviously, the cheaper, the better. And I did put in a high 15% return here. If I just change that to 12.5%, look how it changes the numbers. Obviously, much more attractive. So I think that $42.50 number was pretty good. Company number 2, Match.com. Guys, Match.com is an incredible company. They own Tinder and a bunch of other things. They're the dating company, essentially. Let's go look at this company. Wow, surprised by that. Okay, red flag, boom. Look at their free cash flow. 5-year average is 730. Last year was 506. Look at this dividend they're paying. 3.4%. Don't fall too much in love with this dividend. That's a big number. Even if they're able to do their 5-year number, I don't like a company like this, which has a lot of growth potential. I mean, the world is still getting more and more into dating and more into technology. This is going to be very important. They're going to need their cash flow, especially with such a high return on invested capital. They're going to need their cash flow to go out there and make other opportunities, use other opportunities to grow. So I don't like this right now. This to me would be not a good use of funds if you ask me. All right. Oh boy, look at this. Okay, let's go to our 8 pillars immediately. Oh boy. All right. Expensive, issuing a ton of shares, a lot of debt, lower free cash flow, lower revenue. Oh boy. All right. So on this one, guys, let's go look at their income statement. Interesting. Why is their revenue so flat over the last 10 years? All right. This is a doozy for me. Let's see where their shares outstanding. Okay, so here's the good news on their shares outstanding. Their shares outstanding jumped right here. My guess is some sort of acquisition was made, and they've been buying back shares. Okay, so there's a positive to it there. Let's go right to the stock analyzer tool because we'll look at our analyst estimates. Let's see where the analyst estimates are going. Revenue is supposed to grow from 3.3 billion to 5.3 according to analysts. Profit's supposed to go from 1.4. Wow, look at this. Okay, so if profit can go from 1.4 a share to 540 a share, those are huge jumps. Look at this. This is mid to high 20% range for the next 3 or 4 years. That's big time stuff. And this is in our software. The analyst estimates were just added to our software. It's a great way to get a feel for where the analysts are going. And look for revenue growth. We're looking at high single digits. So from here, let's go to our stock analyzer tool. So again, rewind this as many times as you want to do this. So the revenue growth was not huge in the last 10 years. So I'm going to go negative 2% revenue growth, 0 and 2%. Remember, I'm trying to be conservative. For profit, I'm going to do 7, 9, 11%. Free cash flow, I'm going to do 13, 16, and 19. PE, guys, this is going to butcher it all because this is just an insane PE. I'm going to go with a negative 2% revenue growth. I'd have to go 9, 12, and 15. 9, 12, and 15, and 15% margin. Guys, I'm telling you right now, $58, this is going to be ugly. It's just math. Low side, high side, low side of single digits, high side of maybe 20. For me, guys, I'm just moving on. I don't want to spend the time even understanding this because the price is too far off and there's so much going on. I'm just moving on. Third and final company, SWK, Black and Decker, Stanley Black and Decker. All right. So the company is currently at $89.74. The low is $89.06. A high this year of $200 a share. So it's fallen by over 50% so far in the last year. Let's see. Do they pay a dividend? They do. Oh boy. Last year's free cash flow, they lost $2 billion. 5-year average is $454. Now, keep in mind, this $2 billion loss equates out to negative $400 a year for the last 5 years. So this, before this year, might have been almost $900 million in free cash flow. 483 of that would be eaten up by dividends. So make sure you understand what this reason is. So let's go to the cash flow statement first. Cash from operations was a big drop. Changes in working capital. That's their big change right here. $2.88 billion change in working capital. You add that back in there, if you add that back into there, you're about $900 million in free cash flow, which is about consistent with, so it's a little bit all over the board, but this $2 billion change in working capital, if you look at their history, they had a big one here, a big one here, and that's pretty much it. Okay, so it's something to keep in mind. Let's go look at their 8 pillars. Okay, now here's an example of the PE being lower than free cash flow. Again, we saw this is driven by a change in working capital. Okay, so maybe they're having inventory issues. I don't know. Go do more research on that. That's the thing to figure out is why the working capital charge difference of $2.8 billion occurred last year. That's a big number. A lot of debt. Even with their free cash flow doubling up, it's still 9 times free cash flow if you double up their free cash flow because of last year's fluke $2.88 billion. Buying back a few shares, but look at this. Revenue growth, $2.3 billion. Net income's basically the same, a change in $15 million. Free cash flow, again, $2 billion change in free cash flow. So I don't know how I feel about this. Low return on invested capital. It is based on cash flow, which was driven down a lot. So let's think here. 5-year PE, 12.3. Last year's a 13. Okay, let's go to stock analyzer tool. I'm really stuck on this one because I like the brand. Black and Decker is a great brand. So revenue growth. Let's see. Did they do any acquisitions in the last? Yeah, they did a big acquisition last year. Big one there. They're very active with acquisitions. So remember, acquisitions can artificially grow your revenue, right? So you could have organic revenue drops, but if you make enough acquisitions, it can drive up your revenue, which is a little misleading. You want to make sure the fundamental business is able to grow in and of itself. So let's do -2, 1, and 4% revenue growth. Profit margin, 6, 6.5, 7. Free cash flow. Now remember, it was driven down a lot because of last year. So I'm going to go 5, 6, and 7. PE, 9, 12, 15, 9, 12, 15. And I'm going to do a 15% return. Again, the stock's at $90 a share. Okay, so it's not as far off. Now, you might sit there and say, remember, if I'd done this video last year when the stock was at 200, you'd be like, Paul, you're crazy, 50. Okay, but now that it's at $90, remember, these things can happen. Especially if the market falls, more expensive companies and companies that are harder to understand will fall more. So I'm looking at this going, maybe I want to pay attention and put this at $60. That way it grabs my attention in the software. So guys, if you like this video and you want to understand more about what I mean when I talk about margin of safety, watch our next video that's completely dedicated to margin of safety. And don't forget to follow our channel. Thank you very much for your time.